Welcome back. Chandresh Nigam joining us now, Access AMC. Chandresh, good to have you with us. Let's just get started by getting your perspective on the kind of rally that we're seeing, the fact that we're now seeing broader participation, some key trends that are emerging from the recovery of, over the March lows, clearly heading into a new phase altogether.
Yeah, good to be here. I think that's a fairly broad and an important question. And I think everybody's mind that we've recovered quite smartly from the March lows. The sentiment, which was extremely fearful, has given way to, I would say, some kind of cautious optimism. People have figured out that it's probably not going to be as bad. In the medium term, there is likely to be some effective cure or a vaccine. And in that sense, in the medium term, maybe 12 months from now, businesses, etc., can go back to normal, at least not be affected by the current lockdown kind of situation. So I think there's been some pragmatic reassessment of the risk, which has happened over the last couple of months. And that's led to some kind of differentiation also in terms of understanding on specific businesses. So many businesses, as I'm sure many of the participants on your channel and speakers would have said, kind of rebounded quite well, especially in the month of June, some partly because of latent demand effects, and some because anyway, the impact was not that large, especially in rural areas, etc. So I think if I were to look at this scenario, and there normally we use a tripod model for looking at where the markets are headed and what's happening. One is the macro. So macro obviously was very poor, and there is some expectation that it will kind of move back up. Obviously, we're going to be much lower than last year. There is a debate on whether we are 2%, 5%, 8% lower. So that's not comforting, but yes, the worst is obviously behind us. The second is the micro, which is the corporate performance. And that's where, again, if the macro is not that great, obviously for this year, the corporate performance cannot be expected to be spectacular. But going into 21, 22, which is what the market's trying to look at, looks like at least for some companies, things will be a lot better. Hopefully, we'll get back to pre-COVID levels of activity. The third one is liquidity, whether money is moving in or out of the markets. Obviously, when the fear kind of came in along with COVID in March, April, money tried to move out, and that's why we saw a significant fall. And I think the reassessment of that risk, one, and also the global liquidity, and even in India with money being easily available and rates being low. In fact, rates are coming down every day at the short end of the curve, means that there's enough liquidity looking to kind of get into the markets. So 2 out of the 3 factors are fairly positive. And I would say that within the micro, which is the corporate sector performance, despite we not being able to go back right up to our pre-COVID levels in terms of overall macroeconomic activity and growth, at the industry level and at a company level, there are few things which are working in favor of some of the stronger and more dominant players in the industry. And the theme of consolidation, I think, has played out every time there's been a crisis. So whether there was a problem in economic activity, post-demonetization, or the effects of GST, the stronger ones have emerged stronger. And I think even hence, it is, I think, a rational expectation to say that the stronger ones will come out of this, the COVID crisis also much stronger. And so in that sense, 21, 22 and beyond, some of these companies may actually see a faster growth trajectory as compared to even pre-COVID levels. Though absolute levels may be lower, but rate of growth might be higher. And the third and the last thing which I would want to say from a market's perspective is, I think with this liquidity and low interest rates, I think we have to completely start to relook at, does the market need to be re-rated? Cost of equity, in a sense, should have gone down with the alternate asset classes yields becoming much lower. So I think it's a good balance right now. Some uncertainty on the macro, good liquidity, low interest rates. From an overall markets perspective, I think it's a good place where we are in. And now the news flow on vaccines and cures, etc., and bounce back of various companies, especially I think once this phase of pent-up demand getting over, maybe in the next month or so, and see how the demand really progresses across various segments, will then now drive the markets. And I would think that would be higher, but at a much more measured pace as compared to what we've seen over the last 2 months.
It's good to have you on the show after a long time, I must say. Aisha joining in here. Besides consumption, which you just talked about, where are you a little uncertain? Because across your AMC, your largest exposure is to financials. Then there's consumer staples, materials, IT, and consumer discretionary. And I want to talk about financials, considering in your portfolio that marks the largest weightage. Are you a little uncertain about how things are going to pan out? While the big boys have managed to raise funds in this environment, and sure, that was a prudent move, but you don't know how the entire NPA cycle, the 6-month moratorium, once that gets lifted, how things are going to really pan out. Or would you say that you got to be in the top 5, financial names and stay put for the long haul?
Absolutely. You have to be in the frontliners, the strong companies, and that's not just for financials. I think it's everywhere. It is a pretty rough storm out there, and you want to be in a boat which you know will ride out the storm. I think the point which the market is telling you is that they have reasonable visibility or expectation, if one want to call it, that 12 to 15 months down the line, this COVID-related health issue would be behind us. But in the meantime, there could be many casualties if you're not strong enough. And again, the cost of raising money, which is absolutely the most important competitive advantage for financial services or a financial lending company in that sense, I think is already showing that people are fairly uncertain about the second-tier names. And that kind of completely erodes the competitiveness of the non-frontliners, if I were to use that term. So, and that's exactly what's happening in other sectors as well. We don't really know if the mid-sized players and in some sense the also-rans will really be able to ride out the storm. I mean, there are these data, this set of data which is coming out, which is saying that, let's say simple things like footfalls into groceries and pharmacies is nearly back to pre-COVID levels. So I think those people are okay. I think they will all make it to the other side comfortably. But then when you come to retail and recreation, etc., footfalls are still 60% lower. Now, obviously, some of them will do well and reach the other side, but there will be a number of casualties. I think one of the associations, the Restaurants Association, etc., calling out that anywhere from 20 to 30 to 40% of people, restaurants will not open again. So I think the issue is, I think, very clear. And whenever there is a crisis, the stronger ones, the bigger ones are the ones which actually not just survive, but further strengthen their position, both in terms of market share, as also in terms of RoEs and pricing power, etc. So that's the place exactly to be, Aisha. I think that there's no difference on that. Right now, what we are seeing is a slightly broader rally, which is fair because I think some of these stocks were really, really, really badly beaten down. Not just during the COVID times, but also in the last 3 years as well. If you look at the way the markets have behaved, there have been significant narrowing of the markets, and maybe about 40, 50 businesses doing well over the last 2-3 years. And that's what was reflected in the index, because index, some of the big ones were there having a large weightage in the index. The rest of the market had been languishing. So I would think that after maybe a very sharp drop and then hence a recovery, I think the next 2-3 years again goes back to the more sustainable names where you know for sure they will survive and actually be a beneficiary of the massive consolidation that will happen due to the current crisis. And that's where you would like to be.
Sure. What would you avoid then, Chandresh, in the post-COVID world?
I think whatever is not going to generate the kind of RoEs on a sustainable basis which we are looking at. So anything which does not have pricing power, I think it's not something which you can trade in it, but I don't think it's in the last 10 years, it's created wealth, and I doubt if it will create wealth in the future as well. Especially looking at the fact that even global growth story. The global growth is going to be fairly challenged over the next couple of years. The second one is changes in consumer behavior. I think high-ticket discretionary is going to be a tough area, a difficult area next couple of years. If the economy does not recover fast, and we obviously still keep our fingers crossed on that. If that is the case, then the problem of consumer confidence it's already eroded. I don't think it's really come back. The fact, as I said, that footfalls and stuff is already 50-60% lower. I don't think there's going to be a very quick recovery there. But anyway, we will keep tracking it and see if things change. Maybe the consolidation happens a lot faster, and so whatever is left can grow much faster. But that, I think, is more a story for 2021, 22, and maybe even beyond that. Some of the sectors which, while they are not in the sense that discretionary and high ticket, but people are worried and fearful about going there. So businesses which require significant physical impact or physical interaction. I think those are again places which will be a concern area. So I think the safety probably lies in businesses which are already in some sense seen a good recovery. And it's likely that changing consumer patterns as well as consumption patterns in-house and outside of house, etc., is already fairly understood. And from here on, we can see a significant growth continuing over the next few years. I think financials is becoming that way an interesting area. Some parts of it is probably completely stay away from kind of a situation. And many of them, again, the frontliners, I think, will be a big beneficiary of the consolidation. More importantly, it's, as I said, not just volume growth. I think pricing is going to be, and margins will certainly improve for many of these players. So yes, there are going to be significant pockets of opportunities. And at the end of the day, you anyway need to have a 30-40 stock portfolio. And I think those opportunities still exist in plenty.
Right. Okay, Chandresh, great to have you on the show. I wish we had more time, but good speaking with you as always. Hope to see you more often. We're going to wind up on this edition of The Market.